In Japan in 2008, I think it's pronounced Matibo law. And so if you had a waist larger than 35.5, you were giving dietary advice, but if you didn't stick to the advice, you were fed, pun intended, a bigger tax bill. So just keep in mind, a tax is ultimately designed to control. Otherwise, it just, there's simpler ways to get the revenue.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of PAX Financial Group, and you're listening to Retire in Texas. And if you're looking for a place where we talk finances, but we really want us all to be collectively grounded in the way we think about money. And so if you're looking for something like that, you're at the right place. Remember, this information is general in nature only, not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. A quick commercial. If you want a 15-minute consult with one of our advisors, you can go to that website, click, and you'll get a 15-minute consult. They really are wonderful people, our advisors, and you won't feel any pressure there. They just want to see if it's a good fit. Maybe they can give you some direction and be a thinking partner for 15 minutes. So thanks today for listening. We're closing out towards the end of the year, and I wanted to talk about some of the end-of-the-year tax stuff, even planning stuff in general, and making sure that we're all on the same page. I mean, I can't believe we finished 2025. Time just goes by fast, as we all know. And I was reading in Ecclesiastes, and if you want perspective on life, meaningless, it's all meaningless is what he says, but meaning, and really, we just don't understand the meaning. It's peculiar, and it goes by really, really fast. So here we are at the end of 2025. But I want you to think about maybe some planning stuff to do before the end of the year. Warm up. Let's get warmed up, because I am going to have to talk a little bit numbers today, which I don't like to do a lot of, but let's get warmed up. Pop quiz. What's revenue minus expenses? What is that called? That's called net income. Sometimes we call it profits. Number 2 quiz. What is a plan for future spending? What is that called? It's called a budget. I know. Feels like I'm speaking down to you, but I'm not. I promise I'll tell you in just a second. What is a percentage profit that's owed to the government? What do we call that? It's taxes. I really try to keep things simple. I had it dawned on me once, and that's why I wrote the first book, Small Business, Big Pressures, because I had a CEO come to me once, and he said, man, I am finding myself in a position where I'm having to understand numbers, and I don't get any of this stuff. Can you help unpack it? And I was like, wow, you know what? Maybe some of this stuff that I take for granted is just doesn't translate very well to a lot of people. So I do want to teach, and I just want to make sure that you leave this podcast and go, that made sense. So this one's a tricky one for me to really unpack. So you might have to do some digging on your own and maybe just chat GPT some words that I might have used that are unfamiliar. But let's talk. I'm going to break this up in 4 different tranches. The first one I want to talk about is just your income and deductions. So I'm going to suggest that you review your pay stubs if you're working right now and just double check before the end of the year that the numbers are right. Now, if you're retired, I'd like for you to double check the withholding, maybe on your retirement distributions or any money that's going to you, just to double check on the taxes that are being paid. Maybe take a look at a Social Security statement, look at how much is coming out for Medicare. Just look at those things that you kind of take for granted. The nuances are for those that are working, that have a salary, that after they get paid, they get this net income. What's coming out? Some of which are 401k contributions. Are those 401k contributions exactly what you intended? I've had people for years not pay attention to that and realize, man, I'm not putting in as much as I thought. So you want to get that fixed. You also want to take a look at, withholding. Now, this is kind of confusing to some people, but if you have more dependents, so you could check a box and say, I have more dependents. As a result, you'll have less withholding. And then you might, as a result, get a lower tax return. Does that make sense? Or let me give you an alternative point of view. If you say, I want less dependents, then you're going to have more withholding. The IRS is going to take more, and you might get a higher tax return. So just to manage expectations, I've always said, and you've heard me say this before, that I've been observant of people who have wealth and those that don't over the years. And I've noticed that people who don't have wealth, they hyper focus on their tax returns. That's kind of a big player in the financial world for them. Those that do have wealth, they focus on net worth. Assets minus liabilities equals net worth. So that's food for thought. But I do want to manage expectations when if you are working on what your tax return might look like. One of the really, I think, important things, let me say it with more authority. One of the important things that you should do before the end of the year is just check your spending. I like to use Monarch Money. There's a lot of different tools out there. Ramsey's got some good stuff. But I've always liked Monarch Money because it's very intuitive in terms of the tagging of the types of expenses. It has a good memory and intelligence behind it. So it makes it, I don't like to do the administrative side of just continuing to tell the system how to tag HEB or Target or a gas station. I want it to know. So it's pretty good there. So I can just focus in on the data and interpreting the data for my benefit, my family's benefit. But check your cash flow and your spending. Monarch Money is a good way to do that. Like I said, adjust any withholdings. If you're a business owner, this one's obviously important. You got to make sure you're paying your quarterlies. Check with your CPA, make sure you're doing that the right way so you're not finding yourself paying any penalties. One time I paid penalties for overpaying, so that was stupid. Some people like to do bunching by the end of the year. By the way, not a lot of people, this is important for you to know, not a lot of people get deductions for charitable contributions because the standard deductions are so high. So you get the choice of either an itemized deduction or standard deduction. Itemized or standard. You get one of the two. And so most people, because the standard deduction is so high, you don't get the itemized. So meaning you don't get your charitable deductions. So that's interesting. So some people, this is interesting to think about. Some people avoid this dilemma by bunching their charitable deductions into 1 year. And so then it becomes a big number and it exceeds the standard deduction. Bunching. So some people like to do bunching of itemized deductions in a specific year. That's something you might be able to do and check with your CPA. Let's go to the second tranche here, which is namely, and these overlap a little bit, namely the retirement space and tax, kind of tax advantage accounts. Make sure that you pay attention to those IRA and 401k contributions. The IRA contributions can go into April of next year, so that's cool, April 15th, but your 401k, those have all got to be done by December. You also have some catch-up contributions to consider, so that's pretty cool. They came up with this thing called it was a part of the Secure Act 2.0. It's called a super catch-up for those that are age 60. Just as an aside, Trump wanted to give a tax deduction on Social Security, but there was legislative hurdles to be able to mess with Social Security. So instead of giving seniors a tax deduction or reducing the Social Security taxes, or I don't know how you want to frame that, he created this like a super catch-up provision. You know what? I'm getting ahead of myself. He did that, but I'm going to talk about something else in just a minute relative to the Social Security. So I kind of fumbled there, but there's some. Well, let me mention it. Excuse me for bouncing around. There's a senior credit that I was really referring to. So I was getting crossed in my head. There's a senior credit that was the credit available for those that are age 65 or older. So that's pretty cool. But at the same time, I was also talking about that super catch-up provision. So I'm talking about two different things. In OB3, the One Big Beautiful Bill, OB3, if you're age 65 or older, you get an annual deduction of $6,000. It's a senior bonus. That was the way Trump got around the Social Security hurdles that he came into. But then there's also this thing called a super catch-up provision. That's for those who are 60, they can put a little bit more into their 401k. So sorry to confuse you there, but those are two different things, both benefits. Now, generally speaking, the age 60 super catch up are for those that are working, but the 65 is for anyone. So it's pretty cool. Roth conversions, I think you got to start thinking about that before the end of the year. Very important. Check with your advisor on that. I feel like financial advisors are, not to say I love my CPA friends, but are better at modeling those out than CPAs. The CPAs will double check the work and making sure that the withholding is accurate, but the financial advisor's responsibility is saying, okay, if we convert some of this, what does that do to your future self? Does that benefit your future self? So there's some modeling that needs to be done, but you've got some time to meet with your advisor before the end of the year. So make sure you do that and not miss that opportunity to do some conversions. Qualified charitable distributions are, I think, important for you to consider before the end of the year. That's so when you have an IRA or 401k, you're required to take money out. I was just kind of translating a couple thoughts that I wanted to throw out there, but let me keep it focused on this one specific qualified charitable distribution because I think it's important. You can, instead of taking that money, paying taxes on that qualified charitable or on an RMD, you take the money out, you pay taxes on it, and then you donate it to charity. A better way to do that is a qualified charitable distribution where the money skips you and goes directly to the charity. That's a tax saving strategy that you have to consider. I want to reinforce that. Qualified charitable distribution, if you have required minimum distributions and you are a giver, if you give to charity, you have to consider a qualified charitable distribution. I want you to check with your advisor on that. These are all strategies that I'm giving you a high-level overview of, but I want to touch on some of them that I think are important before the end of the year. We had one case of somebody who had missed their required minimum distribution. Jim and Carol, I'm changing their names, but we'll say they're from Kerrville. And they missed out. They just got busy. By the way, so is it that I've had to deal with this before because we fumbled. We have much better systems on RMDs, but there was a time where we fumbled, and the financial advisor and the CPAs, they do play a role in clients' lives, but ultimately the client is responsible for the RMD legally. But we feel a sense of responsibility as advisors to help the clients. So we set up pretty good systems to catch it. Not perfect, but been pretty good over the years. But this was early in our iteration of PACs, missed the required minimum distribution. The client did, and we didn't have the systems to let them know. And so under the previous rules, the penalty was 50%. You had to pay a 50% penalty. Can you believe that? Under Secure Act 2.0, it's 25%, but if you get it corrected quickly, it's like 10%. I mean, these are huge penalties. This person had an RMD of $18,000. So, I mean, you imagine that's a $9,000 penalty. So you got to get these RMDs done. It's kind of a dumb thing, but it's a system in which the government wants people to take money out of accounts and start taxing it. So it is what it is. You can apply for a waiver of the penalty. It's Form 5329. But make sure you get your RMDs. RMD stands really must do it. So that's important before the end of the year. So make sure you get your RMDs. If you're not sure, check with your advisors. Third tranche here, let's talk about charity, which we touched on a little bit. The qualified charitable distribution, instead of doing the RMDs that go to you and then you pay into the charity, you do the qualified charitable distribution directly to charity. So I love that. Love the qualified charitable distributions. I also love donor advised funds. It's tough to set up a donor advised fund before the end of the year, but not impossible. So any of these things that you're doing, please don't wait to like the last week because it's hard to set things up. But if you want to get a tax deduction in this year, so some people are like, I want to get a tax deduction this year, and I know I can do a charitable gift, but I don't know which charity to give it to. What you do is you establish a donor advised fund and you put it in there, and that gives you a tax deduction immediately, and then you can figure out who to give it to later. So that's a pretty cool strategy. It's called a donor advised fund. My personal donor advised funds through National Christian Foundation, but you can use a bunch of them. I mean, Charles Schwab has them, Fidelity has them. I've done shows on that too. Also, the thing, like if you have a bunch of NVIDIA stock and you don't want to pay capital gains by selling it, you can just give the stock to charity and get a really nice deduction. So that's a strategy too. So those are a couple things that you got to do before the end of the year. Keep good records of all this stuff, of course, and work with your CPA on all of it. I think giving's kind of understated. You hear me talk about this. If you don't know who to give it to, I just did a podcast on the Bereavement Center. I just did one that, helps with human trafficking. I mean, just listen to my previous podcasts in the last couple of weeks, some really important ministries that are helping a lot of people. I serve both domestic and internationally, but my church is my go-to person, in fact, or go-to institution. And recently, with the, we have a lot of military and civil service in our community. So I felt bad for them not being able to, pay their bills while the government was shut down. So me and my wife made a contribution to our church and put it in the benevolence fund that can be used for those families, just to kind of bridge the gap. We actually took it out of our donor advised fund. We already had the money set aside, and then issued it to the church and tagged it benevolence fund, and it was used to help those people. So that's kind of some of the cool things that you can do when you set up a donor advised fund and you're thoughtful about your giving. The last segment I want to talk about this is just, taxes, just family and education kind of tax stuff. Taxes are just really designed to control behavior, aren't they? You think about in the 1820s, Missouri imposed an annual tax on unmarried men age 21 through 50 to encourage men to get married. So if you weren't married, you were taxed to try to encourage you to get married. In Japan in 2008, I think it's pronounced Matibo law. And so if you had a waist larger than 35.5, you were giving dietary advice, but if you didn't stick to the advice, you were fed, pun intended, a bigger tax bill. So just keep in mind, a tax is ultimately designed to control. Otherwise, it just, there's simpler ways to get the revenue. We can talk about that another time, a fair tax, a flat tax. But this tax system that we have is designed to control behavior. 529 is an interesting family strategy, but I wanted to make sure that the 529 does not get you a federal income tax deduction. People ask that all the time, but it does give you a state income tax deduction, but Texas doesn't have a state income tax. But if you're in another state, make sure you're using a 529 that gets you that state income tax deduction. If you have a medical savings account, a FSA, or some type of account that's used for medical expenses, a lot of times it's a use it or lose it program, so double check on that. That's not the HSAs, but the other ones through your employer. So you got to spend that money before the end of the year. Some people have estate tax issues, which is a good problem to have. And in that case, you want to distribute money to your kids, and you can do that each year without filing Form 709. And that's $18,000 a year. If you have a big estate, you want to gift to kids, you don't get the deduction for the gift, but you don't have to worry about filing a form if you do it under the gift tax exclusion. And then again, I touched on this, got ahead of myself, but under the OB3, the one big beautiful bill, age 65, don't forget, you get an annual deduction of $6,000. Again, that was designed originally to be a Social Security kicker to help seniors, but couldn't do it that way. So it's just an annual deduction of $6,000. It's a senior bonus. It does have some income limits on it, so keep that in mind, especially if you convert. This is a little nuance, but if you make a Roth conversion or you're generating some other income in a specific year, make sure you're paying attention to how that might impact that senior bonus, which this is new. So I could definitely see those things being overlooked if you're not careful about it. So lots to talk about. I hammered out a lot of, to me, fun stuff. I still have more. I had more to cover, but I'm gonna conclude there because I think that's a good amount of stuff for you guys to noodle on. I want you to maybe capture a few, check with your advisor, check with your CPA, and make sure you don't start trying to make these things happen the last week of the year. You've got a month here, and I hope this helps you. I hope it helps you think about your money very specifically and with detail. And remember, as always, you think different when you think long-term. Have a great day.